very much. That was a fib about the Donald Trump thing. Didn't see that one coming, I'm afraid to say. But I did manage to fit him onto the presentation, though. So what are we going to talk about? We're going to talk about how to judge the market's mood music for 2017. We've got two other experts here, so I didn't want to delve too deeply into specific products or even too much macro. So I'm just going to look at more the sort of behavioral finance, almost market psychology side of things, just to give you a little bit of a feel for that. I could obviously spend the next 20 minutes reading the next disclaimer, but nevertheless, it's very important, so please just have a quick look at that if we may. And then we're going to talk about the market mood music. What the market's thinking now, what are the implications for 2017? Look at the 4 market moods, maybe a 5th one, and then come to a few conclusions. So why have I talked about 4 market moods? I've done it because of this man, Sir John Templeton, legendary investor, died a billionaire, therefore pretty successful, and certainly more so than I or Charles ever will be. So definitely very well worth listening to. And this fantastic quote of his, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So what I'm going to do in the next 18 minutes or so is look at where there are signs of evidence of those moods in the market right now. If everybody's flat on the floor pessimistic, natural contrarian awkward Yorkshireman, I'm going to be massively bullish. If everybody's tub-thumpingly euphoric and pounding the streets, getting all very excited, I'm out of here. So that's really the way we're going to be setting the scene for the next 17 minutes. So let's start with pessimism. This is one of my favorite charts. It's on US retail investor participation in the stock market. This isn't to say you lot shouldn't be involved in the stock market. 1, because I want to get out of here alive, and 2, because I don't want to offend 210 clients sat in front of my boss. What I am trying to say is what I'm really interested in are headlines like this, except the other way around. So what I don't want are things like in 1929, when Joseph P. Kennedy, JFK's dad, was getting tips from bellboys. So in July 1929, a bellhop gives JFK a stock tip. Joseph P. Kennedy immediately sold everything on the grounds that if the bellboy was in the stock market, who on earth was going to follow him in behind him? There was nobody left to be the incremental buyer. Similar situation in 2000. Everywhere I went, it was on the front page of newspapers, cab drivers were talking about it. The Daily Mirror got involved in terrible trouble for some of its share market coverage. That's the sort of thing that you don't want to see. Now, when I get invited to parties, it doesn't happen very often. I'm normally left talking to a pot plant when I tell people I work in financial services. But what people don't ask me for right now is stock tips, ever. They ask me for lots of ideas on pensions and saving, never stocks. Personally, for me, it's a pretty good sign. Now, what we're not quite getting, but this is the other extreme. What you really want to see is pessimism. You want to see people giving up, throwing in the towel. This is very rude, and I apologize to Business Week. As somebody who's written a lot over the last 25 years of his career, I've got loads of things wrong, so this isn't to poke fun at them. It's just to show you how wicked and cruel markets can be. This is Business Week in summer 1978, a headline, The Death of Equities. And yes, the red arrow, I'm afraid to say, is where that article came out. So, okay, it took 18 months, but then you look at the 1980s, and lo and behold, equities went absolutely tonto. Now, a more recent example, I'm afraid to say Test Daily stock market tips on the front of the Express weren't too much better. Pensions chaos as shares collapse. That was on the 21st of January this year, where the red arrow is. So, to be honest with you, the more headlines Richard Desmond publishes like that, the happier I'm going to be. What I don't want to see, to be fair, the Barron's, one of the sister papers of the Wall Street Journal this week, did publish a Dow 20,000 cover, which you think, oh dear, is that a bit worrying? But given that the Dow was at 19,950 or something, I'm not going to get too upset about that one. But what you don't want to see on the front of newspapers is happy days, isn't it all wonderful, pile in now. And the good news is we're not getting any of that right now. So there's a little bit, there's certainly some pessimism around. There's certainly still enough skepticism. Biotechnology stocks have often been a darling for hot money, for people looking for a quick buck. Had a fantastic bull run for the second time in the last 20 years. Good news is, and this isn't to be nasty about biotech stocks, I think there's some enormously interesting companies there, but they do, let's face it, have no revenues, no profits, and huge market valuations. So it can be where accidents happen. You've seen that just begin to cool off a little bit, which I would personally view as a good thing. There have been a few high-profile drug test failures. Johnson & Johnson's bid for Actelion, the Swiss company, has been cancelled this week. That, frankly, to me, shows that people are not getting completely carried away, which, again, I would view as a good thing. Now, I'm not going to talk too much about emerging markets, because there's somebody here who really knows what he's talking about, will be coming on shortly. But this chart just looks at developed markets against emerging markets. Not all the time, but generally EM, people tend to need a little bit of bull market enthusiasm to get stuck into emerging markets. So I'm always intrigued as to when they're outperforming and when they're underperforming. When that black line divides that index into that one. So when the black line goes down, emerging markets are underperforming. Black line goes up, emerging markets are outperforming. We've just been through, as I'm sure Mike will testify, 3 or 4 fairly tricky years for emerging markets. It's got better this year, but people are by no means going absolutely hog wild for EM right now. And again, the fact that the people haven't really got the full courage yet to go hog wild makes me interested in EM, as a matter of fact, but also markets more generally. You're not seeing the real animal spirits running yet. Lovely picture, isn't it? That's why we're all here. Optimism. This, frankly, to me, is actually quite interesting. It's probably an optimistic sign. Normally I get worried when people start getting all happy. It's a bit of a fiddly chart, but it looks at credit spreads, the premium that BAA borrowers have to pay over the most pristine balance sheet companies to get their bonds away, the extra coupon that they have to offer. And as then their paper, their debt trades on the market, that spread over time does vary. And as we can see right now, when the market is absolutely petrified and things are all about to go to hell in a handbasket, credit spreads start to jump, as we can see in 2001 and 2008. And indeed, there has been the odd panic in the meantime. But in fact, over the last 6 months, credit spreads have come in, which again would lead me to think, actually, at the moment at least, the world is a relatively happy place, and that's actually, for me, a fairly encouraging sign. Small cap stocks. This looks at the Russell 2. I mean, AIM, for example, is really still not doing very much. It's not done very much since 2010 or 2011 in the UK. Individual stocks have, but AIM overall hasn't. The Russell 2000, by contrast, in the US, well, like most US stocks in the last 6 or 12 months, that's gone absolutely nuts. And it is now trading at an all-time high, along with the S&P 500, the Dow Jones Industrials, the Dow Jones Transportation Index, that we'll come back to in a minute, the Philadelphia Semiconductor Index, and intriguingly not the New York Stock Exchange Composite, which is a very broad index, and that's not at all-time highs yet, which is interesting. But certainly this does suggest enthusiasm for small caps in the States. There's some animal spirits there. There's some optimism running, as you would, let's face it, you would expect, given that we've had a 7-year bull run and several indices are now at all-time highs. So that's, somebody somewhere is getting excited, so we need to be a little bit cautious there. One again for Mike, investment trusts. Now, I love investment trusts. I think they're fab, particularly when you can buy them at a whacking great discount to net asset value. And this is something that you can track through the Morningstar research on our website. And my good friends at the Association of Investment Companies helped me with this as well. This looks at the history of investment trusts on a discount to NAV. Remember that with an investment trust, you're not like putting your money into a fund and having your money pooled. You're buying a share in the investment company, in the investment trust, which then moves around according to supply and demand. So investment trusts can, in theory, trade at a premium to the valuation of the underlying assets. They generally trade at a discount just in case something goes wrong, but not always the case. As you can see, we've seen the odd premium creep in here. But equally, as you can see, the last time we got that very short premium, it wasn't a great sign. It came just sort of 12 months before everything went to hell in a handbasket. So generally speaking, what I like to see is a bit of an investment trust discount in there, because it's a chance there's some value there. It may mean simply the manager's had a bad year. Happens to us all. It may mean that that particular asset class is just out of favor right now. If you're looking for a particularly big discount to NAV right now, I think there's that Ukrainian farmland thing that trades about a 60% discount. So, if you want to take on some risk, there's one thing for you to look at. I wouldn't necessarily go overboard on it. But right now, the discount to NAV is net quite narrow. And generally, discounts to NAV narrow nearer the top of the market than they do nearer the bottom. Generally, near the bottom, the discounts widen out as confidence begins to ebb away and tightens up. Now, I think the UK equity income sector is still trading at a premium, which intuitively, much as I love investment companies, leaves me a little bit uncomfortable because you're automatically giving away some of the yield benefit by paying a premium to the value of the assets. But overall, and I'm sure Mike will talk about discounts if you ask him on his investment trust, overall, investment trusts are looking a bit tighter than perhaps you would like right now. So definitely somebody somewhere is feeling quite optimistic. Now, I mentioned the Dow Jones Transports earlier. I love transport stocks. I've got lots of different things to look at, and therefore I have to be sometimes a bit keen on taking some shortcuts. And generally, I'm a great believer in Dow theory. Richard Russell died this year, but he's left Dow theory for us. If transport stocks aren't doing well, industrial stocks probably aren't going to do very well down the road. Why? Because if they aren't moving stuff around, it's not being sold. Dead simple. So actually, it's quite nice in some ways to see the Dow Jones Transport Index at an all-time high. That does give you, again, a little bit of reassurance. It's optimism, probably of the right kind. Equally, you don't want to see transport stocks go bananas and leave the Dow Jones Industrials behind. Nevertheless, that's probably the right kind of optimism. I've mentioned the Philadelphia Semiconductor Index. As somebody who spent 12 years covering silicon chip companies for UBS, oddly enough, it's always interesting to see when the chips are up, or indeed down, dare one say, because if you just think about it, silicon chips, I mean, they're ubiquitous. Yes, we're all very familiar with these things, which are absolutely packed with them, about 1,600 different components and transistors. But, you know, your car, your fridge, all of your home smart meters, pretty much anything that you think of has now got silicon chips in it. And so by their very ubiquity, they're quite a good guide to global economic activity. And the Philadelphia Semiconductor Index, 25 stocks, you can follow it free on Yahoo or wherever you want, currently on an absolute tear. Again, optimism of the right kind, but again, you don't want to see that get too frothy. That's the tech bubble in 2000 when it got completely overheated. So probably the right kind of optimism, but again, don't want things getting too bubbly from here. And then, finally, Euphoria. I'm grateful to one of my production team, Rebecca Bodie, for finding that. She's Spanish, and I think so are they, which is probably why that image is cropped up there. Okay, the NASDAQ composite. We talked about biotech coming off the top. Tech stocks can be a bit of, again, a bellwether for hot money. And lo and behold, the NASDAQ comp is now at an all-time high, a bit like the SOX. So if you really wanted to start painting things a little bit more cautious, you would say, yeah, things are definitely getting a little bit lively. This is more worrying. This is margin debt on the New York Stock Exchange. We've obviously heard our good friends at the FCA in the last 10 days talk about spread betting and contracts for difference and some of the inherent dangers of using borrowed money to invest or to trade. Well, this is again another example. This is just showing you people how much borrowed money is being used to invest in the US market right now. And it's at all-time highs, just under a mere 500 billion US dollars. So in theory, if the market were to ever have a wobble, and occasionally, let's face it, it does, the margin clerks would start ringing up all these people demanding more margin money. That might beget more selling will beget more selling. And that's actually how 1929 went wrong. I did mention earlier on that Joseph P. Kennedy did the opposite to the bellboy. One man who didn't in 1929 was Groucho Marx, who actually was cleaned out betting on margin on a small stock called Goldman Sachs. So the dangers of spread betting and using borrowed money to invest writ large then, and this is the sort of thing that does naturally make you worry. And intriguingly, it does seem as if there is a bit of a correlation between how much borrowed money is sloshing around and the S&P 500. So that does definitely start to raise the odd little alarm bell. And this is probably it's my favorite chart in some ways. It's my least favorite chart in others, because it's probably the most worrying. As somebody who's a great believer in mean reversion, I'm a history student. I accept that investing isn't just about history, because if that was the case, all the librarians would be the richest people in the room. But nevertheless, it is something that we need to take heed of. And this, all right, I've rebased it to 100 just to try and get a feel for it. The black line is US GDP in billions of dollars. The red line is US household net worth, according to my good friend, the St. Louis Federal Reserve Database, or FRED for short. And what's slightly worrying for me here is that helped by housing prices and helped by stock prices and bonds, US household net worth has risen far, far, far quicker than GDP. And long run, I personally don't believe that's sustainable. So either US GDP is going to catch up real quick, or at some stage, US household net worth might just be reduced by a couple of $1 trillion, either because the value of people's house in San Francisco is going down, or the value of Mark Zuckerberg's stock options are going down. So this is definitely something that does make me very nervous, certainly with regard to the US. Regrettably, I can't find similar statistics for the UK, and boy, have I tried. But it is definitely something that does make me a little bit nervous when you've got all of these US stock indices trading at all-time highs, when you've got US property prices trading at all-time highs, bond market's only a tiny bit off the top. There's definitely some optimism out there somewhere, so that's definitely something we all should keep an eye on. And I think probably, because let's face it, it's been a mixed bag. It's not been all one-way traffic, which is great. So there's certainly no need to press the panic button. Equally, if it was all palpably obvious, then we definitely should be doing the opposite. But I think what is interesting, it is a mixed bag. The initial public offering market is pretty cool right now. Mysis has had to abandon its float in the UK. Biffa had to cut its price. Pure Gym was postponed, for example, in the UK recently. M&A, by contrast, has been absolutely rampant this year, and that's, again, quite often the sort of thing that you tend to see at market tops. People using overvalued stock, or what they think may be overvalued stock, to fund acquisitions so they can fabricate growth from somewhere. Maybe it was just because people were getting in ahead of the US election, but I think October saw 7 of the 10 biggest deals in the US this year, huge amounts of debt being raised to fund these acquisitions. AT&T Time Warner was the biggest at 80-odd billion bucks. So IPOs chilly, good sign. M&A red hot. I'm not so keen on seeing that, to be perfectly honest, but never. So again, it's a mixed sign. But I think what the biggest danger probably is complacency. Is that the biggest enemy rather than euphoria? And now it might, because there's this constant faith. First of all, we've had faith in central banks for the last 5 or 6 years that they're going to save the day by printing lots of money. Now that people are realizing that actually monetary stimulus may be reaching its end, we're putting our faith in government and fiscal stimulus. Good luck with that if you think that the government's going to allocate capital efficiently. You're welcome to that view all on your own, because I don't believe a word of it. If there's going to be a project that's just there to create jobs, fine. But if capital is going to be allocated just on the basis of allocating capital, believe me, most of it's going to be wasted, because that's just human nature. So I personally don't have an awful lot of faith in government's ability to get things going, but right now the market does, and so we'll see what happens. But the market is therefore convinced there is a fallback. If things go wrong, somebody's going to flick a switch. Now, David Rosenberg, the strategist from Gluskin Sheff, has also pointed out that I know there's been lots of comparisons between Trump and Reagan. Just think, though, when Reagan took over, US debt to GDP was 30%, not 100. US inflation was 10, not very little. US interest rates were 18%, not 0. And the US market was trading on a PE of about 6, not 18. So there are some quite substantial differences between where we were then and where we are now. So I wouldn't get too carried away with that. And equally, yes, I can see the Keynesian argument, but don't forget that in the 1950s, under Eisenhower, America built out the interstate highways, its biggest infrastructure splurge ever, and it had 3 recessions. So just be a little bit careful of the infrastructure narrative. It may not be all that we lead it to be, but even if the market is undoubtedly in the move right now, to believe. So why do I talk about complacency? Well, I can even quantify it. I can look at the VIX index, the volatility index, that looks at, sort of a measure of future movements in the market. The average is around 20 since inception, and right now it's trading about 11, a level at which you've generally seen, something fairly nasty coming out the corner at some stage, just because everybody's so convinced that everything's fine. It doesn't take much to shake them out of that complacency. So, but that's one thing that I am a little bit concerned about. And although there is a FTSE 100 VIX as well, but rather than just use the same chart, I've manually and intensively gone through the FTSE 100 back to 1995 and looked at every single day when the market's moved by 1% or more from open to close, and then added it up. And as you can see, volatility is at historically pretty low levels. And after a while, it does eventually start to build up, and lo and behold, once it goes nuts, actually that's your buying opportunity there, not necessarily when everybody thinks that everything's going to be hunky-dory. So again, not necessarily optimism, but complacency, something of which we just need to guard. Because in the end, on Warren Buffett's favorite valuation methodology, valuations aren't that cheap. And valuation is the ultimate arbiter of your return from any investment. We all know that ARM Holdings got bought out this year by SoftBank for $24 billion. Don't forget, in 2000, you could have bought ARM for 10 quid a share. In 2003, you could have had it for 36 pence. It was the same company, but the market, its opinion, had just changed ever so slightly in the meantime. One was a major selling opportunity, one was a major buying opportunity. It's not hard to work out which. So it's value. Everybody can spot a great story. It's the price that you pay for it that really makes the difference. This, I admit, is only one measure. It's Buffett's favorite. It's pretty much at an all-time high in the US, but that's easy to justify because corporate profits are pretty much at an all-time high in the US. They did dribble off for 3 quarters in a row, which had me on a state of high alert. It's never happened outside a US recession. Thankfully, in Q3, they bounced back. Good, because they need to, because if US earnings start going down, on that measure, the market looks very exposed. And the same for the UK. Very high levels market cap to GDP, but again, you can justify that dead easy because companies have never been making more money as a percentage of GDP. But you need that to persist, or things could get a little sticky. So where are we in summary with exactly 1 minute to go? As to be expected, there are some signs of optimism. Crikey, we've had a 7-year bull market in stocks and a 30-year bull market in bonds. Things are bound to be pretty much near their all-time highs. And so there are some signs of exuberance, but thankfully it's not uniform. There is enough skepticism out there. There isn't enough widespread participation in the market. It is in some ways an unloved bull market, which frankly makes me feel pretty cheerful about things. The risk may be that people just think whatever happens, somebody's got our back, and I don't want to rely too much on central banks, and I certainly don't want to rely too much on governments. Valuations, well, are pretty full by historic standards in the US and UK. Europe, not the case. I don't think Asia's the case, and I certainly don't think Japan's the case. So there are definitely pockets around there, and we still don't know ultimately which of these is coming. The market thinks that, but back in the spring it was frightened of that, and it certainly hasn't had to deal with that for a while, but that's the worst of all cases. So nevertheless, in the end, even looking at the 4 market moves, we don't quite know what's coming, which is good. And I think probably the best summary there, means that there's no need to panic, but we still need to be careful. And I think as Ben Hunt put it in his very, very good Epsilon Theory blog this week, I think the secret to it is, given the multiple scenarios we could still have, it was very much, his final conclusion was very much in the lines of, don't hold your beliefs too firmly, because we don't know what's coming, but do act firmly on your beliefs. And I think that's probably the right way to go forwards right now. I'm looking forward to taking questions at the end. Thank you for your time.